Validation, now I validate myself. Building inner strength, putting doubt up on the shelf. No more unnecessary drama, no more wasted time. Climbing higher constantly, making my own climb. Standing on higher ground, where excellence is found. My potential knows no bounds. Raising the bar, breaking ground. My network is my net worth. Choose your company wise. Surround yourself with eagles, not with sheep in disguise. Every interaction is a reflection of my brand. Quality over quantity, that's my personal command. Standing on higher ground, where excellence is found. My potential knows no bounds. Raising the bar, breaking ground. Whoa. I'm not just living, I'm manifesting my vision. Cutting through limitations with surgical precision. My expectations are my compass, my respect is my shield. To mediocrity and chaos, I will never yield. I'm not just living, I'm manifesting my vision. Cutting through limitations with surgical precision. My expectations are my compass, my respect is my shield. To mediocrity and chaos, I will never yield. Standing on higher ground, where excellence is found. My potential knows no bounds. Raising the bar, breaking ground. I'm not just living, I'm manifesting my vision. Cutting through limitations with surgical precision. My expectations are my compass, my respect is my shield. To mediocrity and chaos, I will never yield.
How you doing, ladies and gentlemen? Welcome to This and That. I'm your host, Xander, where we talk about this, that, and everything in between. Off to a good start. I told y'all we were going to start roundabout on time at the 10:35 mark, and here we are. That means that, tomorrow, Sarah, I told y'all Sarah's going to be here tomorrow. I'm going to send her an email, make sure that she's up and about for it. And tomorrow, she's supposed to give us a little bit of her time, so make sure that y'all come through tomorrow with y'all's questions, any advice y'all looking for, motivational empowerment information you're looking for. You got questions about the dating, relationships, whatever. Sarah's going to be here as an expert. This is what she does for her profession. Y'all can slide through and ask her some questions. Today, we're talking about money, how to make money for us. And since we normally talk about a different country to invest in on Wednesdays, we pushed that off to Thursday of this week. Izzy, who was here on Sunday, I believe next week, Friday, we're probably going to do a collaboration with him. And then there was another gentleman that I talked to earlier today that when I was in downtown, that more than likely will collab with us later on as well with some motivational and empowering information. So we're going to be seeing a decent quantity of increases of extras on the show. So I want you guys to make sure that whenever y'all slide through, because we're live every night. We don't let the sun rise without going live. Sometimes we're on time, sometimes we're a little bit late, operating on CP times. Things happen, life happen, work all day, all night, but we always here. So if you miss it, you can always come to the YouTube side of things, see the backed up version of it, and get everything included in the comments in the comment section in real time. So when I start giving y'all stock tips and I start putting them stock tips in the comment section, y'all can go back into the comment section, pull them stock tips right on out. For those of you that's watching us on Twitch and Twitter, special shout out to y'all. I know that the people that are Twitter heavy, the X group, going up against Donald Trump's social reform, whatever podcast channel thing. I know that beef is got y'all weary, but I ain't trying to steal y'all from Twitter. I'm trying to get y'all information so y'all can share, y'all can like and subscribe on YouTube so that you get the push notification that the show went live, and then log in on Twitter. I don't care. You can log in on Twitch. I don't care. I don't care where you come from, as long as you're here, so you can learn something for free. So you ain't got to go to a seminar and have them feed you some bullshit for $29.99. You can slide through here and get the exact same information and more. All you got to do is just ask some detailed questions on the back end. It's an interactive podcast. This means that if y'all got questions, I got answers. Don't think that you're looking at me and listening to a good show. You're looking at me as a person who's got answers to questions and information about stuff that you want to know about. And if I don't have the answer off the top of my head, usually I do, but if I don't, I'm going to do some research on it and get you a factual response, usually within 24 hours. So you'll know if, like, why you asked me something today. If I ain't got the answer, you come to the Mars show. That's one of the first things I talk about as soon as you jump in the comment section, is exactly what you want to know. The legacy that I'm building with this particular podcast is to be factual information 100% of the time, where you learn, grow, and improve based off the information you get from me. So special shout out to, there's a laundry list of individuals, everybody that values the show, that shows a lot of support to the show. And I really appreciate y'all for coming. And right now I'm going to hit these investors. For those of y'all that came for the money market information, we're talking about like market in motion topics, where we're going to turn the complex world of investing into actionable strategies that you can use right now. Because today we're diving deep into the heart of investment strategies, what works, what doesn't, and how you can harness the power of sector rotation, dividend capture, and more to supercharge your portfolio. Because we're already working on our dividend capture method. We've picked up about 10 or 20 different stocks. Some of them are monthly stocks. A lot of them are quarterly stocks. You can do a buy and hold with a monthly stock because it pays every month, but the quarterly stocks only pays once a quarter. So if you're rotating your money from stock option to stock option, you buy in a few days before the stock hits, you sell a few days after the stock hits, and then you keep it pushing. You have to recognize the dip in the value of the stock when you buy in and when you sell. But if the stock levels off or powers up before you sell it, you can get you a gain on the stock and get a stack of cash on the dividend exchange. So since we understand that, in hypothetically, theoretically, you can get 168%. That's like best case scenario. Every trade hits on the right day, every sale hits on the right day, and you don't miss a beat. However, realistically, you should see between 70 and 80%, if not 100% return, where you put up 1,000 and you double the money by the end of the year. You put up 10,000, you double the money by the end of the year. You put up 100,000 and you double the money by the end of the year. Now that has nothing to do with taxation. So if you make 100 grand, they will tax you. Since this is going to be on the regular tax bracket, and it's different from the buy and hold, because if you do a buy and hold, they have tax breaks for the buy and holds where you have 0% for head of household up to 64,000 and 0% for married couples up to 97,000. There's your incentive to get married, to save money on taxation for buy and holds on stock options. But you first have to make that money. So you're going to have regular taxation levels for the buy and sells, the quick flips, and then you just rotate that into some buy and holds. Now, we've talked about some other ways where we can use tax deductions to not evade, but bypass taxation when we're making a ton of money. I was actually talking to somebody about that earlier today. But what I want to talk to you about is having that as a problem, because let's be honest, you want big money problems. You want to not know what you need to spend your money on so that you don't have to pay as much taxes. You want to have made so much money that you have to pay taxes. You don't want to be in a situation where you don't got enough money to pay your bills and you begging the government for a handout. So I would prefer to be in those situations. And that's what we're going to be talking about here. So let's kick things off with a simple question for our lives. I want to make sure that the audience is gamed and tuned for this. How many of you have ever wondered if there's a best way to invest? Is it value investing, growth stocks, chasing dividends, or just parking your money in an index fund and letting it ride? If you're nodding your head, you're not alone. In fact, a 2023 Gallup poll found that 61% of Americans own stocks, but only 17% feel very confident in their investment strategy. That's a confidence gap we're here to close today. So the building bricks that we're going to be utilizing is the 9 common investment strategies. So let's lay the foundation out here. There are 9 widely recognized investment strategies. I've talked to you about 2 of them already. And these are the ones that the advanced and moderate to advanced investors use, from Wall Street pros to Main Street beginners. They also use this too to grow their wealth. So you don't have to be an A-class star veteran to know how to get this done. All you have to do is have a couple ducats that you can let go, and you can follow this method. There is always a learning curve when you don't know what you're doing. But when you buying and selling and you're making something off of it, even if you sold low and bought high by accident one time, because that's how you're supposed to do it. If you sold low and bought high by accident one time, and then you sold low and bought high on purpose the next time because you've seen the results of that, the learning curve is the part of investing. But if you accidentally bought high and sold low and you lost out on some money, you gonna not make that mistake a second time, because don't nobody want to leave money on the table, and nobody wants to just give money away, especially when you're giving money away to somebody who don't need it. So let's talk about this value investing. Value investing, growth investing, and dividend income investing, index passive investing, dollar cost averaging, buy and hold investing, active investing, asset allocation and diversification, momentum investing. Let's talk about that. Y'all like, holy crap, what did he just go through? These are the ones. And I'm going to take it, like I told y'all, I'm going to take them, I'm going to put them into the comment section so y'all can see what I'm talking about. These are the strategies. And if you want to go through these strategies, you can, I'm going to put them up a few at a time. You can do some research on which type of investing that you want to get into, and then you can double back and talk to me about which one of the ones you want to get into, and I'll give you all the information, and you can cross-check what you found versus what I found and see which one of us got the most information. Because I'm not going to say that I'm right and you're wrong, but if I've got information that you don't have, guess what you just got? If you got a bunch of information from me, the rest of the information that you was missing to do what you wanted to do successfully. There isn't any right or wrongs in a situation, because you have a lot of people in life that will tell you that what you're doing is wrong. Just because you don't like what I'm doing, don't make it wrong. What I'm doing is wrong when what I'm doing compromises my ability to succeed. It's wrong when the law say it's wrong, because the law's punishments are going to compromise my abilities to succeed. So ultimately, when the outcome is unfavorable to my expectations, that's when what I'm doing is wrong. That's not a moral or ethical scenario. That is first person accountability. You know what I'm saying? If I do something that causes me to lose out on what I was trying to accomplish, it doesn't matter if it was done for a good cause. It doesn't matter if there was a noble intent behind it. What matters is that I messed up a good deal. That's what matters. What matters is that I put a bunch of money on the table. I said something stupid and I lost out on a bunch of money. When that happens, you're going to learn from that mistake. See what I'm saying? So I'm not going to tell you that I know more than everybody in the world. That would be a lie. I'm not going to sit here and tell you that I know more than you. I know different information than what you know. And sometimes we might know the same information. So if you're seeing what I'm throwing up here right now, you see the, go through the list now. You got the value investing, growth investing, dividend investing, value investing, growth investing, Look, I said it twice. Dividend investing, index, which is passive investing, dollar cost averaging, buy and hold investing, active investing. Each one of these strategies is followed by the word investing, so you know which strategy it is. Asset allocation and diversification, momentum investing. These are the 7 that most people are using. So let's break these down with real world examples. Starting with the value investing. Think Warren Buffett. Value investing is about hunting for companies trading below their intrinsic value, which right now in the current economy, while we're in the downturn, you're going to see a lot of companies that are being sold at 47% their original value before the tariffs started hitting, before Donald Trump started doing all kind of reckless stuff. And if you buy into them and hold on to them until the stocks level off and go back up to their original value, you could potentially double your money. But if you're trying to buy, hold for a little bit and then sell on a short note, you might see a little bit of an income as the economy stabilizes, getting used to the current tariff situation. Hathaway, Buffett's Berkshire Hathaway has averaged a 20% annual return since 1965, compared to the 10% for the S&P 500s. Anybody pulling 20% or more off of stock options, where the S&P 500s is pulling off 10%, you doing something, because the S&P 500s is the top 500 companies that are making some profits. But how is he doing it? By buying undervalued companies and holding them for the long haul, not for the short take, for the long haul. With dividend capture, we're doing a short take. We're getting in, getting our money, getting out, like set it off. The key matrix in this type of structure is the price to earn ratio, where the cost of the stock divided by how much money you make off of the stock is the ratio. If that ratio is low, that means there's a lot of money involved. If the ratio is high, not so much so. Now, just because it's 0, don't mean that you get a ton of money. It's 0 because there are no profits coming out of this purchase. So there will be no earnings from the investor until they sell. That's going to be the difference between having a P&E, having a high P&E, or having a low P&E. Now, the lower the better. If the fundamentals are strong, you'll see a lot of success on that. Fun fact, if you invest $1,000 in the Buffett, if you would have invested $1,000 with Warren Buffett in 1965, right now in 2025, which would have been, what, 60 years, you would have over $30 million today. Just put your $1,000 in there and leave it there. But see me, I'm not trying to wait 65 years. I'm already middle-aged. I'm trying to hit my stack within 5 to 10 years. If I can hit my stack in 15 to 20 years because I spent more money than what I was planning on spending, but I still made it to my meal, that's what I want to do. Number 2, growth investing. This is going to be another one that we're going to be trying to see how to work into coming soon. If you picture the tech that is booming right now, even though it just went unstable because Donald Trump said he was going to stop messing around with SpaceX because he don't like Elon Musk. If you put your money into the tech scenario, growth investors will chase companies with explosive revenue and earnings growth, like Apple, Amazon, Tesla. Not so much so right now, but Tesla used to be one of the ones that we would put our money on. But because of the rocky relationship between the government and Elon Musk, Tesla might not get. And then the protesters out there acting a fool outside the dealerships, Tesla might not be where you want to put your money at right now. But those used to be the go-to names to utilize when you was running through a tech platform. So back in the early days, that would have been a good one to invest in. Today, you got to rethink your position. Stats from 2010 and 2020, where the NASDAQ 100, which is a growth-heavy index, returned 20.5% annual, outpacing the S&P 500s at 13.6%. Now, there's risk with growth stocks, which can be volatile. So you want to remember the dot-com bust. And many high flyers crashed and burned during that era. And this is something that's just going to have to happen, because if everybody put up a stack of cash, only half the group is going to get this. The other half is going to lose something. So if you put up a bunch and you're on the losing side, you just lost a bunch. But if you put up a little and you're on the winning side, you just gained a bunch. Because in order for money to change hands, somebody's got to lose. You just got to make sure that you're not the loser. Now, when we're talking about the dividend and income investing platform, this one is for the income seekers, individuals that's looking for that cash, that quick cash, to help them build their principal by adding more money to the principal throughout the transaction. Dividend investing is going to mean that you buy the companies that pay you to own them regular increments, often in quarterlies, if not monthly, cash pays. And this is going to be for the life of the ownership of the stock. Now, over the last 50 years, dividends have contributed roughly 40% of the S&P 500's total returns, which means that if you had a dividend capture platform that was primarily a dividend capture platform, you would probably see a lot more cash returns off your investment than what you would if you was putting your money into an S&P 500, which is why you got to do your research, because putting it in an S&P 500 might play it safe because it's going to be a bundle thing. Whereas if you select a few, like we've selected a few on the show quite a few Tuesdays in a row, you would be able to see, oh, well, I could do X, Y, and Z with this and still make money for me. Some of the favorite sectors that we've seen in 2025 is going to be utilities, customer staples, and healthcare. Now, in a real life, real world scenario, retirees often rely on dividends that supplement Social Security. Some of them, or most of them, are lucky that they ended up hitting with the VA. But whenever you gain money, they take money. Y'all know what it's like. So let's go ahead and talk about the index investing, which is a passive investing scenario. If you set it and forget it, buy a fund that tracks the S&P 500 or another index and let the market do the work. Over 80% of actively managed U.S. equity funds underperformed their benchmark over the past decade, where S&P, Dow Jones, and indices in 2023 were all pissed off. So why does this method work? Low fees, broad diversification, and no need to time the market, which means that at any point in time, you can get out there and go and do what you got to do and make you some money. You just got to do it consistent enough where nobody's going to run to the competition. Now, when we're looking at dollar cost average, we invest a fixed amount at regular intervals where, rain, sleet, or shine, we're going to put that fixed amount into the stock. And that's just what it is. Now, this smooths out your purchase price over time and reduces the risk of buying at the top. For example, if you invest $500 every month, sometimes you'll buy high, sometimes you'll buy low, but over time you benefit from the market, which is a little bit different from them benefiting off of you financially. Now, buy and hold investing. This is going to be another one that we have discussed in various ways, but now we're talking about it in a different dynamic. So you want to pick great companies or funds and hold them through the thick and thin, where it's time the opposite of trying to get time to market to making time. See how that works? When we start moving forward and looking at Fidelity, we realize Fidelity is found in their best performance when they're acting on accountants from 2003 to 2013 and belong to people who forgot they had an account. So no trading or just buying and holding. That's individuals that make that trade and then walk away from it and be like, yeah, it's going to make money for me forever. That's not always a good look. As an active investor, this is going to be something that's going to be more hands-on. Some people might not believe that that's a thing, but that's what it is. Active investors trade frequently, trying to capitalize on short-term market moves where technological analysis, news, and even gut instincts can kick in and give you something more relaxed than what you were looking forward to. Frequency trading can risk up fees and taxes, but we're going to be getting a larger quantity of that depending on who's in office. Only 20% of day traders are performable over time before or during Barbara and Odin. What do you think about that? I'm eager to know who Bargain and Odin is. Make sure somebody throw it in the comments as to who that fella really be by. Now, asset allocation, that's going to be the diversification of, I'm over here looking at how my mic wasn't where it was supposed to be. I'm like, oh, I don't know if they can hear me, but they could because I was at 88. Where assets and diversification pull all your eggs in one basket and spread it to spread your investment across all of your stocks, bonds, real estate, and everything else. Now, the asset allocation is going to be explained over 90% of the portfolio's long-term return, such as Branson, Hood, and Bauer. But once it's like your money and your stock, that's your money. I don't care what your people is going to do with it. If they got a noble intent behind it, they'll do something noble. But if they don't, that's it for your money. You have to rebalance annually to stay on target. Because as things change with age, so does desires. So when we're ending up in those moments where investing turns out to be a thing, what do we do about that? Because you don't want to ride the wave, because riding the wave means you're behind the tide. Momentum investors buy what's hot and sell what's not, counting on the trends to continue. In an example, tech stocks surge and momentum fades, which outperform the broader market by over 10%. And when we look at sector rotation, this is the ultimate active strategy. So let's zoom in on one of the most dynamic strategies in anyone's playbook. Now, while we look at what's happening with the nurse, you have sector rotation, which is all about moving your money and between differences, which I said 30 minutes ago, there was between differences, but for some reason, didn't nobody want to break up the fight. I don't know what we're coming to, y'all. I feel like we're coming to an end. And then I just seen Usman's report. Special shout out to Usman. Usman has been a diligent individual to the show. Be smart. Day tripping. All right, we go with that. Man, y'all know I have been. I'm always burnt out, but I have been burnt out today. I done had a message and a half. I was excited. Then I started looking at the rational side of things. I'm like, man, I got to go to work. Gave up on the whole idea. I told y'all we put our brain skills where our money is. Excuse me. So what we're going to be doing is looking at sector rotation and moving the best move. Now, sectors like tech, healthcare, energy, and financials based on whether you think economy is ahead. So why do it? Different sectors output at different points in the economic sector. When the economy is booming, customers discretionary, where the tech often leads to some drop downs for something other than oxygen. Now, during the recession, utilities and healthcare tended to shine because more people was paying for them lights because they needed them lights when it was cooking in the dark. Which, by the way, I got to make two Fit Chef videos. I got one recorded. I've got the other one. Well, I got two recorded, but I got one of them that I went and picked up in person, and the other one that's being recorded. So we're gonna be seeing what those shoes are like. Yo, outfits like. So how does sector rotation work? Let's get interactive. Imagine you, for some reason, ended up collecting $100,000 in a portfolio. Depending on which country you're going to, the U.S. economy is entering a recovery phase after a recession. What sectors do you overweight? And it looks to me like he didn't have very many answers. He pulled the answers where if you type your picks in the chat, we'll be able to organize the data and determine truthfully which one's not actively doing their part. Now, in the early expansion phase, industries and consumers discretionary stocks historically outperformed, and the classical mature technology and financial take on the leadership. That's a whole nother story. Now, one of the things that the rich do is that when it slows down, you get off the machine, you start heading towards blackjack, and the consumer slaps. The consumer staples become safe havens. Yeah. Now, from 1997 to 2023, the average national sector for performance spread was 40% points between the best and the worst scale. That's disappointing. I'm looking for more than that. They're talking about fidelity. Is any of y'all going to stay with a 40% stock when you could be making 100? I don't know. I could be wrong. Some people really need that 100. But that's going to be a huge opportunity for savvy rotators. So what strategies power sectors that you have dealt with your ability to radiate rational thinking and promote blending? Let me know. Now, what strategies power sector rotation? We're going to be looking at a blend of several core strategies, including inactive investing. You are not sitting back. YOU is Y, and then on delta. Okay, cool. Or on data, where the forecast is sometimes a gut instinct instead of actual facts. I don't like that. I don't like that at all. He said, thanks, Sander. We put our brain skills where the money is. President Elon and myself taking notes. Usman always gives me a pick me up. I really love it. I'm over here drinking all this water because I'm trying to crash soon, but I ain't trying to crash during the show. Assets and allocations and diversifications. We're not talking about the Doge contract. We're talking about doing something a little bit different with board and planes and everything like that. So your spreadsheets and your bets. Bets is going to be like, what are you expecting the market to accomplish? and how that's going to positively or negatively impact the amount of money you invested. So if you're spreading your best efforts and you're tilting towards sectors with the best outlook, then you can fall into momentum investing, where some sectors rotate, and Chase recently has a winner in investment, which means you just got to get up and go out there and go grab it. The best trends to utilize is the ones that persist. That resistance model that everybody says, oh, we don't like that. Stop resisting, stop resisting. That's what it saves your lives. Now, on a macro factor based edition of investing, you're looking at economic indicators like the potential for asterisks that indicates that there's more to it than what meets the eye. Whether you can see them more or not, that's what it's for. Now they're looking at the GDP growth and they're expecting that to guide their sector picks, but that's not necessarily the choice that they're going to make. Now the reversion and contrarian investing is going to be another thing that's going to get in your way, but others look for lagging in sectors poisoned for a comeback. And that's how they end up getting everything that you've got for the flag that was in there. Now, I know that I had some people telling me what was going on with sector rotation. Is sector rotation something that pops up when the car is in drive, or is it something that only pops up and pops down when the car is off and in park? And he was like, it starts right up till the oil change needs to be chased out. You know what I mean? So what sector rotations is not? Which one is it not? And then you want to take the time to invest your not. Now, when you're hunting for undervalued companions, it's not pure growth, but investing through nightmares and favorite the other individuals. You got to work on that. Lord, I got here early. All right, so sliding on down to the next one. It's not the method that we were just talking about is not a buy and hold. You're making frequent changes, and it's not dollars to cost average. So you want to talk about a twist on sector rotation, dividend rotation or dividend capture rotation. You just snag one of those and go up there and go get it done. Now they have this other question up there. This is for me, those who want it, capture it. That would be a great way to show clippers. And then dividends that you get by buying stocks just before they pay out, then sell sooner after it hog dries. But, before the ex-dividend date cuts the divine and sells it, you should be able to see your victories. Now, one quick sidebar here. I want to ask you guys exactly how much do you get out of the deal? That's a good question to ask. And real quick, before we get started walking into those, I want to give you guys there it is. Look now. I'm giving y'all some that didn't nobody even see. I'm saying, hey, what are you doing? Take a look at this, because I'm waiting on Mr. Satellite to go. I'm gonna give you guys something real quick before we get into the next data strategy. Check this out.
I'm not just living, I'm manifesting my vision, cutting through limitations with surgical precision. My expectations are my compass, my respect is my shield. To mediocrity and chaos, I will never yield.
All right. So special shout out to Mr. Satellite, because y'all know Bayside gonna dive in here one more time. And I wanted to talk to you guys real quick, because when we're doing this with the dividend capture method, you'll see stats like the average dividend yield for the S&P 500 companies be about 1.5%, as stats have been raised in 2024. But by rotating through the yield stocks, some investors have aimed to boost that to about 3% or more, which is doubling the amount of money that you can make off of your investment. But that's just off of the S&P. With the rising value of stocks, we're doing it with dividend capture, which is allowing us to get paid off of the dividend payment and the increased value of stock. Sometimes we get a difference between the two, but a lot of times we get exactly what we're looking for. Like, matter of fact, if you haven't done it already, International Seaway is providing, if I remember correctly, $1.74 a share if you pick it up before the 12th. Today's the 10th. Today's the 11th, because it's after midnight. So if you were looking for International Seaway, as y'all see, I'm throwing it up there, y'all will have exactly what you need for today's Tuesday. Well, today's Wednesday, so that'll be Thursday, where you would be able to see a decent return. And depending on how much you put up there, you would see exactly how much more you're going to get back. Essentially, a couple grand will get you almost $400. You're giving you $1.74 a share for a $33 stock. Think about that. Don't nobody think about that part. Don't nobody think about that part. They just think, oh, well, I'm going to buy something and then let the interest happen. I'm like, nah, if you buy that son gun and then you sell it at the right time, you buy at $33, $34 a share, you buy 2,000 of them, you're going to have a few hundred shares. And a few hundred shares give you $1.74 a piece. You end up with a few $100. Now y'all gotta look at these twists and turns on here, because that's one of the things that not too many people pay attention to. Now, understand that stock prices often drop as soon as you buy them by the dividend amount, and sometimes that drop stays after the payout. So gains are likely to be offset unless more people are buying in after the ex-dividend date. Any individuals that's still buying in after the ex-dividend date are intro level investors, because any intermediate level investor would see that they missed a deadline on that stock. They would wait 25 days and try to get it again. Because why put my money down on a stock that's not going to pay me for 3 months when I can wait 2 months and then buy the stock early and then have the stock when everybody else start buying into it? Then when the stock plateaus, I sell the stock before it takes a dip. It's going to go down. Whatever goes up goes down. Not too many things you see on a steady incline. But one of the things y'all got to make sure that y'all pay attention to is that depending on the platform that you're using, you might have trading fees. Every platform is going to give you 1099s because you're going to have taxes. And this could eat away at your returns. Your 168% interest off your investment might only leave you walking away with like 75 because you had to pay for everything else. And since they can eat at your return, a lot of people find that they don't have value in the amount of money that they got by putting in all this effort versus the amount of money that's they standard living with no effort. So I completely understand that. But for the rest of us who don't have it like that, it's like, bro, we got to make our money move. We got to be active traders. Active traders and hedge funds with low transactions in a lot of situations not recommended for most individual investors due to its complexity, not because it doesn't work, but because it's a very complex scenario. And if you're thinking about real world examples of sector and dividend rotation, take this out for a minute. Main managements have an active sector rotation platform that uses both passive ETFs and active selections based on fundamentals. They also include valuation and industry trends in their decision making as well. Blending value and growth while analyzing within an active rotation model gives you the ability to be a little bit more financially successful. The next one we're going to talk about is the vintage beacon with the 3.0 model. Employees have a moving average that is identified as momentum. And they're going to weigh it equally to something else. You're supposed to be trying to do this with an active rebalancing base on, and you're going to be basing that off of the technology and the fundamental signals. So you're not just putting your money on something that somebody told you to. You did your research and you went and confirmed that, yeah, that's the way it's supposed to be. That's the way I wanted it to look, right? That's what you're hoping to gain. But here's an interesting question, though. Have you actually tried dividend rotation? Let me know what your experience is. Make sure y'all share that experience in the comment section. Now we have a data that is behind sector rotation. Say, for example, Morningstar in 2023, which is a couple years ago, they had sector rotation funds outperforming the S&P funds in 7 of the last 15 years. But they underperformed in other areas. Underperformed meaning that they did not get the value that they were supposed to be getting. And you understand the reason why is that if you don't look before you leap, leaping is tough. Timing is tough. Your risk tolerance is tough. You got to work on that fidelity, where the difference between the best and the worst sector in a given year can be over 50%, where in 2022, technology soared 43%, while energy fell 33%. SPIVA had a scorecard, and the overall long run was most active managers lag passive benchmarks, but top sector rotators that can outperform if they get the timing right. I'm telling y'all, I've talked to some investors who were watching the trends and started doing it right with the trends and put a large stack of money in there and gave himself $150,000 salary because he was make money for him. Yeah, that's dirty. But that's how you keep your hands clean. Now, when looking at the sector rotation and dividend capture, you ask yourself, are powerful but challenging active strategies exist? Well, if they do, they require research, discipline, and willingness to make bold moves. For most investors, you want to start with the foundation where you're diversifying using index 500s and dollar cost averages. And if you want to try sector rotation, you want to use as many portions of your portfolio and track your results. And I told you that before, because if you track your results, you can see what you're doing differently than what you would subconsciously be doing if you did not have that hurdle there. Now, you want to remember that even pros don't get it right every time. They're going to make mistakes and they're going to take losses. Donald Trump said, because Donald Trump got his money from an inheritance first, and then he started moving his money around all over the place, and he still ended up making himself a billionaire. But every financial loss that he took before that, he made a massive gain as a result in the back end. So my question to you is, are you guys ready to try some of the sector rotation stuff that we've been talking about, or will you stick with tried and true strategies, something that you guys already know about? I want you guys to let us know exactly how you plan on trading. Like, what strategies did you learn that we may not know that might be a good thing to do? I know a lot of people say don't give away the tricks of the trade, because if you give away the tricks of the trade, then it's not a trick no more. One of the things I've learned is that you're more successful when everybody has public knowledge, because it is public knowledge. It's not a secret. Now, the difference is that those ambitious individuals are going to dive in and they're going to just start working, looking for their paycheck whenever the time is up. The skepticisms, they're going to be sitting there with the paycheck in their hand and still reluctant to work because they're not sure if you're going to continue to give them money. You got to be the latter. You got to be the former, actually, the individual that, didn't come all together. But you have to understand that investing isn't a one-size-fits-all scenario. Whether you're a valued hunter, a growth chaser, or a dividend collector, or a sector rotator, the key is to understand your strategy and then know the risks and keep learning. So I'm glad you guys rode the whole wave with us the entire night. That's actually very impressive. I want to give a special shout out to the rest of y'all that's been looking at us over the show tonight. And you got to think to yourself, when you're thinking about markets in motion, if you enjoyed this episode, and then let me know what you enjoyed about the episode. Now, on my way out of here, I want to let you guys know that y'all should be able to like and subscribe at the very least, and then share some of this knowledge with somebody that you know. So as you flip through the channel on YouTube and you look for some of the shows that's been archived, you're going to go and pull all the Tuesday shows, because that's where all of the money transitions start occurring. We talk about the bulk of the conversation of money in the middle of the street. That's how we get it done. Now, with that being said, I want to say before we walk out of here tonight, ladies, as long as the situation doesn't make sense, I'm going to keep asking y'all to make it make sense. So ladies, please make it make sense. And then fellas, I want to let y'all know that we're still a male-driven podcast, 75%. We're still running deep, but we're still trying to find the value in us so that we can project that value to other individuals that will then maintain a level of attraction to us, because we're attracted to, what we got going on. And I'm okay with that. As long as you're going to be cooperative and aid my success, that's fine. Because men that are considered good men typically are expected to do the exact same thing. I'm just hitting it with another spin, because in modern times, we have successful females that are not experiencing that same, heat that men feel. So I want to make sure that we give the women props as well, because they still grind it. And then men are still going to expect women to do the female responsibilities at the house. So you're switching up partial roles. I believe in uniformity, but you got to fix your relationships and you got to fix your finances. You can't do them at the exact same time, because you have to focus on one, overcome that, and then focus on another one. Every time you improve your shortcomings, you no longer have those as shortcomings. But as long as you recognize that there is a flaw there and you're not putting any effort to fix it, that's when you start seeing a problem. So make sure that you guys stay tuned for tomorrow night, because we're going to be starting off at 10 o'clock on the dot. We're going to have Sarah come through the show. She's going to be giving us some insights, so make sure that y'all like and subscribe. And I want to thank you guys for coming to This and That, where we talk about this, that, and everything in between. I'll see you guys tomorrow night.
Higher ground. Used to chase validation, now I validate myself. Building inner strength, putting doubt upon the shelf. No more unnecessary drama, no more wasted time. Climbing higher, constantly making my own climb. Standing on higher ground where excellence is found. My potential knows no bounds, raising the bar, breaking ground. My network is my net worth. Choose your company wise. Surround yourself with eagles, not with sheep in disguise. Every interaction is a reflection of my brand. Quality over quantity, that's my personal command. I'm not landing on higher ground where excellence is found. My potential knows no bounds, raising the bar, breaking ground. I'm not just living, I'm manifesting my vision, cutting through limitations with surgical precision. My expectations are my compass, my respect is my shield to mediocrity and chaos. I will never I'm not just living, I'm manifesting my vision, cutting through limitations with surgical precision. My expectations are my compass, my respect is my shield to mediocrity and chaos. I will never yield.